China, Taiwan, and the boycott. 11 Chinese missiles landed in Taiwan's waters this past week, including one directly over Taipei, all while Chinese military exercises were conducted in 6 zones surrounding Taiwan. The recent Chinese power demonstration is the largest cross-strait exercise in decades. It is the most recent act of Chinese aggression in an ever-escalating tinderbox of conflict. Domestically, there are power struggles going on within China which are only ratcheting up tension for the CCP even further. It's no secret that for the past few decades, China enjoyed world-leading economic growth. However, double-digit economic growth can only go on for so long. A natural cooling of the economy is not unexpected and is at times considered healthy. Growth cracks. Much of this economic growth has been supported by massive amounts of corporate and household personal debt. And it looks like the chickens are coming home to roost. The chart we're showing you here compares the household debt, that's personal debt to GDP, for China compared to the same metrics for the United States. So it's basically comparing the debt of an average family in China to the GDP of China to the average family in the US. And if you look carefully, you'll see that the Chinese household debt relative to the GDP has increased by over 250% since 2005. For comparison, the same metric, the United States, which has seen household debt to GDP decline, went down by 16% over that same period. China and income. Let's drill down a little bit deeper. In China, you can see that disposable income levels relative to debt have soared 5-fold since 2006. That indicates that Chinese incomes have not risen nearly as fast as the debt they have taken on. In simple terms, they're taking on more debt than money they're making. That's the chart you're looking at right now. And if you compare it to the US, which has also decreased during the same time. So the Chinese are increasing by over 5-fold, and the US during the same time has decreased. Chinese mortgages and housing. Much of the debt taken on by households in China, the US, and elsewhere is mortgage related because it's usually the largest purchase an individual will make in their life. Fueled by low interest rates, rising equity prices, and strong economic growth, citizens around the world have been loading up on real estate, and China is no exception. Recently, however, for many Chinese citizens, these projects have not come to fruition. Hundreds of Chinese citizens have taken to state-run social channels like WeChat to voice their displeasure. This has led to a mortgage boycott where many Chinese homebuyers are refusing to pay their mortgage. The leverage dynasty. It's no secret that many Chinese real estate firms like China Evergrande are over-leveraged. When the times were good, they spent frivolously and expanded recklessly. Evergrande even bought their own soccer team, usually a bad sign. When crackdowns on lending began to occur in 2020, these developers had to slow down or halt construction completely. All while the buyers, the average people, had to keep paying their mortgages on these unbuilt homes. Now these home buyers are refusing to pay their mortgage payments on the construction projects, which are sitting idled. This trigger effect of crackdowns and failed projects is leading to a surge in Chinese defaults. The next chart you're looking at shows the actual Chinese defaults of onshore and offshore defaults. So the blue is onshore, the 12 trailing months, and the red is offshore. You can see the significant increase. This is done in US dollars and it's in billions. Now let's look at the default rates. Looking through a different lens, you can analyze the data through default rates. You can see that issuers, especially offshore bonds, are seeing default rates soar to multi-year highs. That's the red line. Look at the offshore default rates. That's significant. In the last 12 months, 27 issuers that hadn't been in debt trouble in the past have already defaulted. This is an ugly trend that the Chinese government cannot be happy about. And let's focus on the too big to fail card. There are a dozen issuers facing debt payments over the next 30 days, which could make the default rate climb even higher. I suspect that the CCP will continue to allow mid-size, the ones that are not too big to fail, to actually fail. and this sends a strong message for the rest of the group to get their houses in order. But when push comes to shove, the CCP will likely step in and support the largest of the loans, which are usually the too big to fail tycoons whose political ties are in line with the establishment. But that's no different than in the US. China's central bank is looking to issue $30 billion worth of low-interest loans to commercial banks. These banks will then be allowed to leverage the $30 billion up to $148 billion in liquidity for the property sector. Gotta love that multiplier effect. Is this enough, you may ask? Well, not really. Evergrande alone has $300 billion in development liabilities. Make no mistake, the CCP does not want China to become a declining superpower this early in the game. It will do everything in its power to make sure that doesn't happen. What does this mean for the rest of the world? A lot, especially for commodity investors. China has long been a major buyer of commodities such as copper, zinc, iron ore, and crude oil. Look at the chart right now that shows how important China is to the global economy and commodity markets. So you look at China as the red, and you look at the rest of the world in blue. Over half of the copper and nickel and iron ore that is produced and consumed globally goes to China. In today's world, investors need to be acutely aware of macroeconomic changes. China's developments should not be taken lightly. Just like how market participants took a few months to understand how COVID was impacting China, so too could be the case here. I recently outlined in my latest issue to subscribers how I am managing and looking to capitalize on the Chinese risk. I outlined a full playbook and analysis of the number one company I am targeting over the next few months. If you want to give yourself an edge and find out which sectors and all the companies I'm putting my money into, it's all detailed every month in my premium research service, the KRO. Stay safe. Subscribe to the KRO, which is a Katusa Resource Opportunities, to find out exactly what prices I'm buying at and what price I sell at before the trade occurs. And you get to sell before I do. If you want to give your portfolio an edge, consider becoming a member and giving it a try for yourself.